Please stay tuned for important disclosure information at the conclusion of this episode.
Hi, and welcome to The Long View. I'm Jeff Patak, Chief Ratings Officer for Morningstar Research Services.
And I'm Christine Benz, Director of Personal Finance and Retirement Planning for Morningstar.
Our guest on the podcast today is Gatti Tassin. She's the creator of the Money with Katie blog, podcast, and newsletter, which was acquired by Business Insider's Morning Brew in 2022. The Money with Katie podcast is consistently one of the best performing finance-related podcasts. Katie started up Money with Katie after stints as a content designer and writer for other firms, including Meta, Dell Technologies, and Southwest Airlines. She received her bachelor's in Communication and Information Sciences from the University of Alabama, where she was a presidential scholar. Katie, welcome to The Long View.
Oh, thank you. I'm happy to be here, Jeff.
Well, it's our pleasure to have you. Thanks again for coming on. We want to start out talking about your story, your decision to start up the blog, newsletter, and podcast lineup called Money with Katie. What audience and what needs were you trying to address with your content?
I started the brand with the blog in April 2020 and then kind of expanded from there. But I really started it as a means of sharing what I was learning about money management with other women my age, because I noticed at the time that none of us really knew what we were doing. And a lot of the information that I could find was one of two things. Either it was really, really detailed, but super dry, or it was so hyper targeted to women that it was almost patronizing in nature. Like it was this very Yas Queen oversimplified vibe that I didn't really get much out of. So I wanted to provide a resource that was really rigorous in its depth and in its research, but also entertaining and funny and relatable, because selfishly, that's what was fun for me to make.
So you went on this journey where you're trying to build your knowledge of investing in personal finance. I'm curious to know, as you were working on that and on that path, what were kind of the key resources that you found useful?
Oh, yeah. Well, so my entry into the personal finance world was through the lens of the financial independence, retire early movement. So I joke that it's kind of like, you decide you want to get into rock climbing and then you go take your first lesson from Alex Honnold. It was this very intense, extreme philosophy, but it really shaped my early perspectives about what was required to be successful with money. So at the time, I was listening to a lot of Choose FI. I was reading Mr. Money Mustache and Mad Fientist and these other guys that were, kind of the founders of that space, and they all have very extreme takes on the best way to achieve this goal. But from there, once I got more comfortable and once I started to understand more and, reading a lot of books and this stuff started to feel like repeat information, then I got more comfortable branching out, seeing what else was out there and kind of having a little bit more fun with it. But I was pretty hardcore in the beginning for sure.
I think we want to talk more about FIRE a little bit later in our conversation, but I'm curious, had you always been interested in matters of money and investing? Were those topics you and your family discussed at home, for instance?
Yes and no. My parents were always very open about money with me. They were super savers. Like we lived in the same house my whole life. We took a total of 2 vacations over my 18 years at home that were not to see my grandma. Like my mom tracked every receipt in a spreadsheet that they had for 20 years. I think you could still probably go back and find like what they spent on restaurants in February 2002. It was intense. So they retired in their early 50s and they just set this world-class example financially. However, money burned a hole in my pocket. I did not inherit the saver gene. So I really had to cultivate that intentionally because I was a natural spender and I had to unlearn a lot of my patterns around how to behave with money and really reframe the power of wealth, really, and the power of compounding. Because in the beginning, I just figured, hey, it's $1 I'm going to spend today, or it's $1 I'm going to spend 5 years from now. What difference does it make? But that was kind of the fundamental flaw. I didn't realize that no, $1 today is actually worth quite a bit more than $1 5, 10, 15 years from now, because you can invest $1 today and turn it into something else. So that was kind of the key switch that had to flip for me.
So the Money with Katie podcast is often one of the best performing financial podcasts. Do you have a sense of the types of folks who are listening and consuming your podcast, but also consuming your other content?
Yeah, weirdly enough, on the podcast front, I really don't. I'm not sure if it's because we just don't have access to the right type of data, but our podcast audience is one group that in the whole ecosystem, we actually know the least about them. Though I would say, judging from the reviews, I think it's safe to say they're typically more educated and more critical than our audience elsewhere. Like, they expect more from the show, they have a higher standard, but it really runs the gamut. I do think that the general audience, particularly on social media and like our newsletter following, they are primarily female, probably 70% female, 30% male. And majority of them are in that kind of 25 to 34 range.
What do you view as your key differentiators in what is a pretty crowded space of personal finance education? We started the conversation and you quite helpfully explained kind of your origin story that, you wanted to split the difference between sort of that real rigorous and dry content and that other content that you just weren't responding to for various reasons. Maybe it was being patronizing. So that's clearly a differentiator. But what else have you found has really helped you to break through?
Yeah. Our old tagline was a personal finance blog that you actually want to read. So I think it comes down to making something genuinely entertaining, but like we said, not sacrificing on the substance. So I think about it like a combination of depth and personality. Like, if I'm awake, I am thinking about this stuff. I'm pretty obsessed. So I try to bring that level of curiosity and intensity to everything that we make. And I think it's worked well because, and I hear this from other young women, so I'm hopeful that this is still accurate. But what I found that I was hearing a lot, especially in the early days, was like, I don't care about Roth IRAs, but you get so excited about it that it makes me excited about it. So I think there's some genuine enthusiasm that comes through that you can't really fake. Like, you either feel that way or you don't. And I think that's partially why some of the topics that we cover are so all over the place, because I really try to only do these deep dives and cover topics that I feel genuinely excited about, because when I feel excited about it, then it's entertaining and, exciting for the audience too. So that's kind of been our guiding principle. And sometimes if there's something that we think might work and then we get into it and it's like, you know what, I don't think there's something here. I actually don't really feel very good about this anymore. We'll scrap it and we'll do something different. But I do think that has been a big thing for us.
Can you talk about what your business model is for the Money with Katie empire, let's call it? Your firm was acquired by Business Insider's Morning Brew last year. So are you still in charge of all the content? Can you talk about that?
Yeah, well, I love that you called it an empire. You know how to make a gal feel special. Yes, so I am still with Morning Brew. Let's see, I was actually out there in New York with them just last week. So that was really fun. But yes, I still decide what we cover. I write everything, record everything. So everything that you're seeing on Money with Katie is still coming from me, but it's nice now that there is kind of a deeper well of resources that I can pull from, and video editors and audio engineers and, editors for the content itself. So that's been really, really helpful. But as far as our business model goes, we basically have two big primary sources of income. One is advertising, so through brand sponsorships and then, some affiliate stuff here and there, and then direct revenue from our flagship product, primarily the Wealth Planner. So the Wealth Planner is definitely our highest grossing product. It's a digital tool that you can use to kind of keep track of all of your financial life in one place. But we do have merchandise and we have a course. So we're trying to beef up those other areas. But I'd say that's kind of the bread and butter of the direct revenue side. So yeah, it's probably like 60 to 70% advertising and then 30 to 40% direct revenue from direct sales.
think you recently did a webcast about what you call the monetization of self, basically building and profiting from your own personal brand. How do you decide
Mhm.
which parts of your life and story to share with the world and which to keep private?
Yeah, well, part of the inspiration for that episode was that someone asked me a while ago, "Hey, like, I get money with Katie, but what's Katie? Like, what's the difference between you and this online persona?" And I realized that there really isn't one. Like, I didn't approach the divide between my online self and my actual self with any degree of intentionality because it didn't occur to me to do so until it felt like it was almost too late. And so, in some ways, that openness has been a bit of a secret sauce because it feels like you're learning from a real person. But on the flip side, and part of what I covered in that episode was like, there's something kind of vaguely dystopian about having to monetize your personality and feeling like you have to put everything out there. So, to give a specific example, my husband is a very private person, can't relate. But, I don't share him because he does not want to be on the internet. And that has been a good, kind of boundary area for me of, we'll talk about how much we're spending, but people for a while thought that he was fake. It kind of became a joke that like Katie's husband isn't real because you never saw him. And I used to share our financial progress really openly. So like net worth updates and things like that. But I've pulled back on that as I've gotten further along and the platform has grown because my very private husband is an attorney and he was like, "Yeah, don't do that anymore. Don't put that on the internet." So there have been things where I started out very open and then as things grew, it was kind of like, it may be time to revisit this.
Can you talk about, or maybe kind of bucket the major subjects that you address in the podcast and newsletter and on your website? Can you sort of group the type of content into some specific categories or themes?
For sure. I would say that broadly speaking, we tend to focus on kind of two key areas. So it's either everything would fall into the tactical side. So things that you will read this or you will listen to this and you will walk away and there will be some action item that you can take with you. Or it's philosophical. So there's no takeaway. There's nothing that you're going to, learn in this episode that came out of the tax code, but it's going to make you think about money differently. So within those two columns, on the tactical side, we'll talk about investing and diversification. We'll talk about advanced tax strategies and, how to pay no income taxes in retirement, how to structure a drawdown perfectly optimally for a married couple, things like that. We'll talk about budgeting and kind of the brass tacks of how to set up a spending plan that's actually going to work and calculate your goals. So we do cover those things because they're all very important, but we also really like to focus on the philosophical side into things that impact young people on a daily basis. So think things like the economy and student debt and the housing market. And, what does it mean if the Fed is trying to force a recession? What does that mean for you? And how has the world changed in the last 20 years? How is your life going to be different than your parents, maybe? And how is your wealth building journey going to look different? So, like I said, it kind of, if something feels really interesting to me, I feel like nothing's off limits as long as it's kind of financially adjacent. I will find a way to shoehorn it into our content roadmap because if I want to talk about it, I'll find a way to talk about it. But I would say, generally speaking, it falls into one of those two broad categories.
You often write about investing matters. How would you describe yourself as an investor and how has that changed through the years?
Oh, yeah. Well, when I started investing in 2018, which kind of an interesting time considering what came after 2018, I'm like, investing is easy. You get 20% returns every year. Anyone can do this. I didn't know anything. And I'm really thankful for people like JL Collins, who I think y'all have had on before, who
Yeah.
popularized really simple investing strategies that made me feel comfortable enough to start because it gave me the confidence that like, oh, this is easy. Anyone can do this. This isn't hard. And in a raging bull market, yeah, I mean, everyone feels like a genius, but in a way, it was a blessing. So the biggest shift for me over the last couple years has really been recognizing my own recency bias around favoring large cap growth and then diversifying beyond it. So adding in small cap value, emerging markets, global stocks ex-US. Like as I learned more about historical returns and the power of diversification through different economies and monetary policy regimes, I felt more comfortable branching out, and that has definitely served me well. And I would say, lastly, I realized that, a year or two ago, I would say that the most valuable thing that I could do was focus on increasing my income faster than I was increasing spending and prioritize shoveling as much money as possible into the compounding machine, as opposed to trying to optimize for an extra 50 basis points here or there. It felt like a larger lever that I could pull was trying to increase my income and just keep that trajectory climbing. And that has served me really well.
You referenced J.L. Collins, Katie, and we have had him on the podcast. His philosophy is to keep it super duper simple. Like, I
Mhm.
think he's not even a fan of international stocks for most
Yeah,
investors.
no.
So, but he's also a big index fund enthusiast. Is that your mindset too?
Yeah, for sure. I would definitely consider myself an index fund girly.
Did the experience of last year change your views on anything, the way that the market behaved, and specifically that stocks and bonds declined simultaneously?
Not really, but only because I feel like 2022 was such a genuine outlier given what preceded it. Like, I think it would have been weirder if things didn't totally fall apart after a global pandemic shut down the world and all of its supply chains for months. I don't think about what happened in 2022 as invalidating of my core beliefs about how to structure a portfolio, but I do think that 2023 so far has reinforced for me just how strong our bull market recency bias was. So I think it was, if anything, like a very good wake up call that 50-year-olds should not be in 100% S&P 500 portfolios, which is something that sounds crazy after what happened last year, but is something that actually I think felt quite safe up until recently. You didn't really raise an eyebrow at that. I met people in their 50s whose money managers had them in 100% S&P 500 and they were retiring in a couple of years. So I don't know. I think it's exciting to me that we are entering an era that is actually historically more common, wherein bonds are back and you don't have to take on excess risk to chase yield.
What do you think of target date funds? Do you think they're a good hands off option for people, especially those who are just starting out?
Yeah, I mean, to me, the data around target date funds performance really speaks for itself. I know Vanguard has released data in the past that their investors in target date funds pretty substantially and consistently overperform the investors who are trying to do it themselves. That said, my only criticism is that I find they tend to be too conservative, or rather, they tend to get too conservative too early. So, my personal approach has been buying target date funds within my 401k, where that's like the primary option, that are farther out than my actual retirement date. So, I may plan to retire in 2050, but I'll buy a 2065. I also like the Paul Merriman 90/10 portfolio, where I believe they suggest putting 90% into a target date fund and then putting the other 10% into something like small cap value so you can make it a little bit more aggressive. But I think generally they're a great invention.
You referenced the period earlier on in the pandemic where we saw a lot of newer investors dabbling in pretty speculative assets. You probably encountered this with some of your peers or perhaps some of your listeners where people were trafficking in meme stocks and crypto, certainly. What were you thinking and maybe saying to your audience during that time?
Well, honestly, I was like, these people are nuts. I don't know if I am just not imaginative enough, but I tried, like, really, really tried to understand the underlying value of things like Bitcoin and NFTs. And I just couldn't do it. I could not square the supposed value with the price. So I just stayed away. And by the way, like my husband invests in cryptocurrency. So I say nuts endearingly. I'm like, okay, well, whatever. Keep it to your 3% allocation or whatever it is. But I think my fear of losing money was greater than my fear of missing out. And fortunately, at least from where we're sitting right now in January 2023, it saved me from a very expensive mistake. I don't know what'll happen in the future, but I think it's important to have an investor philosophy. And, mine is really contingent upon, do I understand why this thing has value and how it makes money? And if the answer is no, then I stay away. So I stayed away.
Many people start out in investing by buying individual stocks, as you know. Do you think that's a good way to get started, in your view, sort of experimenting, even if it maybe isn't the most optimal way to approach investing?
Yeah, I mean, I think whatever helps you get skin in the game is a good way to start, even if you end up losing money. Like, ideally, of course, you would jump straight to the boring stuff and be like, yeah, I'm going to index fund and chill. But sow your wild individual stock oats if you need to. I think if that's what's going to get you in the game and get you comfortable with investing, then fair. And you might get lucky. I mean, I was just with my grandparents over Christmas, and my grandma, she invested $1,000 in Toro stock in the 1980s. And now the $1,000 is worth like $250,000. So I was kind of plugging it in and trying to see. It was a CAGR of like 15%, just an absolute monster. So we were joking with her that, oh my gosh, Grandma Jean, you should have invested $100,000. We could have all been retired by now. We would have been able to tell people we're old lawnmower money. But, it doesn't work out that way most of the time. So I think if it's how you want to get started, there's nothing wrong with it. But I do think the data pretty clearly points you in the direction of index funds. And I think most people eventually find their way there.
What's your take on ESG investing, environmental, social, and governance oriented investing?
Yeah, conceptually, totally aligned. In practice, I fear it is mostly marketing. Um, Beyond that, there is something about it that doesn't quite make sense to me about fund flows. And like, keep in mind, dear listener, I'm just a gal with a podcast and a blog. I'm not a wealth manager. I have no licenses. But in order for me to divest from, let's say, an objectionable company or industry, I am selling those shares to someone else, which means it doesn't actually really materially affect the company. Like, I am no longer invested, but in order for me to sell, I'm selling to another person that now owns them. So I think until it happens at scale, I don't know that the net effect is actually helping, but I don't know. I would say jury's still out for me on ESG.
When do you think it makes sense for someone to hire a financial advisor, and what should they be looking for in seeking an advisor?
Yeah, I think, in 2023, most, I'll say regular people probably don't need one unless your situation is relatively complex. And so by relatively complex, I would say a couple things fall into that category. You're a business owner, especially like a business owner with employees. If you own real estate or multiple rental properties, if you have a 7-figure net worth, if you have complex insurance needs, like in those cases, I would say you should probably look at a fee only CFP or a full service AUM model with a very, very low fee, like 50 basis points or fewer, so that they can holistically plan for you and ensure that you are not missing anything. I don't have an advisor, but I do pay a CPA every year to look over things for me. I am pretty dang intimate with and involved in my own financial life. So I feel pretty confident in my ability to manage things myself, but it is always nice to get that gut check from someone that has the license and has the letters after their name. I just worry about the model wherein, you have the 2 calls per year and you're paying 1.5% of your net worth, and they're investing you in mutual funds with high expense ratios and front load fees. I think that era is on its way out because I think financial technology has disrupted the use case for doing something like that. But I do think like fee only CFP or full service AUM model where it's a relatively reasonable fee, I think there's still definitely a place for that. It just depends on your situation.
So, what do you think the financial and investment industries should be doing in order to better serve younger clients? And then maybe you can put an even finer point on it and talk about what they should be doing to serve younger female clients.
Ooh, I like that. Everything pink. No, I'm just kidding. That's like
And maybe there's
definitely
no
not
difference.
No, I think I'll start with the age thing. I think young investors have something older investors didn't when they were young, and that's widespread access to the internet and this type of information. So I think they know what the opportunity cost is of paying 1% per year for fancy mutual funds that are probably not going to outperform the broader stock market over time because they follow someone on TikTok that showed them the math. So it makes it a pretty easy cost benefit analysis for a young person. And I think younger people are very aware of the compounding effects of fees. Now, there's also a lot of bad information out there. And I think there are a lot of insurance salesmen on TikTok that say, oh, don't use a 401k, don't use a Roth IRA. You don't want to invest in the stock market. You want a whole, universal life insurance policy. So I think there's plenty of noise out there too. But between the access to information and companies like Betterment, M1 Finance, Wealthfront, you name it, that can really take the guesswork out of investing, I think the conclusion that I have reached is in order for, real people or real humans who want to serve young people in this space, I think it takes a few things. It's low fees. It's a holistic full service approach so that, maybe you as a client do need insurance, but you probably don't need a whole life policy if you're 23 and have no dependents. But you may need an umbrella policy if you are worth $1 million because you just, got a bunch of ISOs from your early days at Facebook. I mean, I think there's other things that young people still need help with that require a professional. And I think that holistic model still makes a lot of sense. And as far as targeting young women specifically, I think there is, whether it's earned or not, I think there is a view among young women that this field is not for me. Well, there are no advisors who actually want to work with me who aren't going to talk down to me. But young women are graduating from college at a rate of 2-to-1 to young men, and they are slowly overtaking the workforce. So when you think about who's up and coming affluent, who's, high earner, not rich yet, it's a lot of young women. And so I think it's a huge market that you have to take seriously. And in order to serve them in a way that they're going to be willing to pay for, I think you have to bring more to the table than just investment advice, because they, in many ways, rightfully feel as though they can get a diversified portfolio elsewhere for free or almost free.
And so what are those other things that somebody should bring to the table in order to convince younger women that, they should entrust themselves to the advice that they'd be receiving or otherwise receive services from them? What else do you think those things are?
Yeah, I mean, I think it comes down to thinking about the parts of their financial life that they probably would not want to spend the time digging into in order to get the right answers. So for me, that's taxes, that's insurance, that's estate planning, that's some of the tax implications that can come along with real estate. I think things like that would really set someone apart. And I'm sure that is pretty par for the course for some of the, firms that are already kind of offering everything. But I think to me, that is a bundle of services that would be worth paying for. Even to me, someone that feels like I know a lot of this stuff already. I feel well-versed and confident in a lot of this stuff. But I mean, I do think there's something to be said for the audience that, maybe they're making good money, they're highly competent, they're very interested in building wealth, but they're also very busy. And so they are willing to offload some of that responsibility and time to somebody else. I think that's kind of the target demo. But I don't know. At the same time, I also stand by the fact that no one is going to care more about your money than you do. Even the best advisor in the world or the best CFP in the world, ultimately, it's still your money and you still need to be highly aware of what is going on.
You referenced earlier on in the conversation, Katie, your introduction to this space really was focused on the FIRE movement, the financial independence, retire early movement. And you've said that you want to be at the work optional or financially independent stage by the time you're 30. So I'm wondering why or how you set that goal, and how will you know if you've achieved it? How will you know whether you have enough?
Yeah. Well, it's funny because the finish line just keeps moving. Every time I reach it, I'm like, well, we should push that out just a little bit more. I think it's a goal for me mostly because of fear, if I'm being honest. I want to feel by the time I'm 30 years old, like I can take my life in any direction without being concerned about how much that direction is going to generate an income. Like I would rather grind it out in my 20s, set myself up for life, and then spend the next 20 years maybe having a family, starting another venture, taking time off, doing all three. I don't know, whatever it is. I never want to feel trapped. And I think the fear of feeling trapped in a situation that I don't want to be in is a big, big motivator for me. So right now, I think I have a number in mind that I think is realistic to hit by 30 if I stay on my current trajectory. I'm 28 now, so it would be kind of end of next year or like early 2025. But I don't know. So far, I had a number before and the goalpost moved. So I think that's going to be another challenge to contend with once I get there.
You've talked about how you and your husband have managed to save a really high percentage of your salaries. How have you managed to do that?
Yeah, also fear. Yeah, things have been going really, really well for me in the last couple years, but I realize that that will not last forever. Like just because I'm a high earner now doesn't mean that I will be next year or the year after that. And so living close to the edge never really felt worth it to me. Like we could live in a fancier house, we could drive fancier cars, we could wear fancier clothes, but I think the price that I would be paying for those things would be my peace of mind. And right now our save rate hovers around 60 or 70%, and that feels really good to me because I know that I have a lot of margin. And we're still able to live a really great lifestyle, but I think having that margin is important to me.
You recently got married. You mentioned that you and your husband aren't on the same page with respect to disclosing personal information, but are you on the same page with respect to money matters and especially the goal of saving so aggressively?
Yeah, he's actually probably more aggressive than I am in his frugality. I'm the one that's more apt to be like, let's splurge. We can afford it. And he's the one who would be like, but who cares? Like, we don't need it. Why would we? So I think we balance each other out. He's also more aggressive in investing. Like I said, he does invest in crypto. He's been investing in Bitcoin since 2012 or 2013. So he has been bought in for a long time on that asset class where I was like, nope, not interested. But it's funny because when I found the fire world, we had kind of just started dating and I really got him into it too. Like he really loved the like gamification of how cheaply can you live. And so he really liked it. And then when we started earning more money, I was like, all right, I'm ready to start going on trips and going out to eat. And he was like, wait, but no, we have all these, we have all these goals. So I think that that was kind of an interesting like shift in the dynamic of no, we're still going to be relatively extreme, but we're going to do it in a more comfortable and sustainable way because now we can. And so, yeah, it's been good that he does kind of see things the same way. I think it would be much more difficult if we were on totally different pages.
For people who might be listening, how would you suggest they balance the things that they might like to do when they're young, like travel, alongside the quest to save more for their future?
To me, this is one of those things where it's a balance that you'll probably never feel like you've achieved it perfectly, but it's always something that's worth fighting for. There are certain things that you will be able to do when you are 23, like hostel hop around Europe and stay in terrible accommodations and, stay up all night and take red eye flights and whatever that you're just not going to want to do when you're 43. So I think take advantage of those experiences while you can. They are pretty cheap after all, and you have the energy, the time, the back for it. The types of things where if you don't do them when you're 22, you're probably never going to do them. But balance that with realizing that you are probably also going to want to go to Paris when you're 43, not 23. And that time, you're probably going to want to stay somewhere really nice with a Tempur-Pedic mattress, and you're going to want to eat at great restaurants, and that costs money. And if you start saving and investing at 23, you will have the money to do that. So I think it's kind of a false choice that we're presented with, where it's like, should I YOLO it up and blow it all now when I'm 24 on bottle service and clubs, or should I, never leave my house and retire a multi-millionaire at 50. It's like you can do both. You can't try to take the metaphoric 43-year-old trip when you're 23 because that probably would break the bank. So I think it's about honoring the life stage you're in and giving your future self a shot at honoring that stage too.
Social media contributes to our culture of getting and spending. What advice do you have for people to avoid falling into the trap of overspending and feeling that need to kind of
Mm-hmm.
flaunt the trappings of material wealth?
Oh, it's a hard one because it's so endemic to our culture. But the best thing that I've done for myself as a material girl, a reformed material girl, as I like to say, is to contextualize how much money these tastemakers have. So, for example, Kylie Jenner, she's a very famous kind of Gen Z icon. And she has this bracelet stack that she wears at any given time by the jewelry designer Cartier. She probably has 6 to 8 of these things on at once, and these are, mind you, $7 to $10,000 a piece, but she turned them into almost this, like, casual designer item, which is ridiculous because it's like wearing a Honda Accord on your wrist. But Kylie Jenner is worth $1 billion. So I did some quick proportionality math one day when I was like, should I get me one of those bracelets? This is a pretty cute bracelet. And I realized that her buying a Cartier bracelet as a percentage of her net worth is like me buying something that costs $4. $4. Like my Starbucks order is a larger percentage of my net worth than Kylie's $10,000 Cartier bracelet. And that really put things into perspective quickly for me. And, I'd also argue it's probably a good use case for why we should tax people like Kylie Jenner more aggressively, but I digress. I think it's really important, though, to examine who you are kind of admiring and maybe trying to emulate. And then sometimes you just got to put yourself in check and be like, that's not where I am though. Like I'm not on her level. I can't flex like that on people. I need to focus on getting the Starbucks order in line, not not how I'm going to get the Cartier bracelet.
One subject of debate among personal finance people is whether it's important to have a budget or whether people should reverse budget, set a savings target, and then make sure their spending conforms to that target. How do you think people should do it?
Yeah, I'm hesitant to say should anything, but my general perspective is that what gets measured gets managed. And I would consider myself an extremely financially fluent person, and I overspend when I stop tracking. I think humans are just not innately very good at eyeballing this kind of stuff. So I do think that there's an extent to which you can dial up or down how granular you're getting for your personality and for your preferences. But I definitely think the like, oh, you don't need a budget. I think it's a slippery slope for 99% of people. That said, I do think it's a psychological game that you have to play with yourself. Anytime you feel really restricted, you are going to lash out and overcorrect. It's just human nature. So it can be valuable to have certain categories where you are going to give yourself free reign and categories where it's practically impossible to overspend to a large degree just by nature of the type of purchase. So, like, a popular example is coffee. Even if you buy an expensive coffee every single day, you're probably never going to spend more than, I don't know, $200 a month on coffee. That can be a relatively inexpensive psychological win that will help you stay on track in areas that are a little bit bigger or trickier. But I tend to skew more to the side of like, when in doubt, you should probably be tracking it. Like, do I think Jeff Bezos needs to monitor his grocery spend? Like, no, he owns Whole Foods. He's probably fine. But for the majority of us, we're going to be well served by knowing where the money's going every month.
Many people are emerging from college with staggering amounts of student loan debt. How would you suggest that people balance the loan pay down with investing for the long haul?
Yeah, yeah. I mean, this is a tough one. And I would add historically unprecedented. Young people starting out life with a mortgage sized amount of debt over their heads with no asset to offset that. Like, we've never really seen that play out before. So I do have a lot of empathy for people that are in this position. I'd say tactically, the first thing I would look at the interest rate. And I'd say if you're paying down a loan with an interest rate of 3 to 4%, you have relatively cheap debt, I wouldn't rush it. I would make your minimum payments and then direct any excess investable income to a more productive path, like investing in the stock market, or hell, even right now, T-bonds or real estate, or, whatever it is that you feel it best fits your goals. But beyond that, I mean, debt can be really, really psychologically burdensome to people. So I think there's an element of this that's, if you're on this journey, it can be helpful to really celebrate and kind of gamify the progress that you're making. So in the wealth planner, we have a debt payoff section in the net worth tab where every month you're supposed to go in and actually record the new balance. And watching it get smaller as your net worth gets larger is super intoxicating. So I would recommend determining what portion of your income every month is going to go to work for you, making your net worth bigger. Whether that is via investing, whether that's paying down debt, whether it's doing both at the same time, making sure that there's a specific portion of your income that increases your net worth, because you are deserving of financial progress and you should also benefit from your hard work, like not just your employer or the companies from whom you are purchasing things. Like, you should be directly benefiting from that labor as well. And this is a really direct way to make sure that that happens.
I wanted to ask you about housing. I think you said that one of the biggest money myths is that buying a home is a good investment. Why are you unconvinced that's the case?
Yeah. I feel like anyone over the age of 40 right now is like, oh, she doesn't know anything. But I think to me, it's really simple that your cost basis matters when you're talking about what makes a good investment versus a bad one. And simply put, houses right now are no longer cheap. Like, the stock market isn't cheap either, by the way, but you can dollar cost average into a stock market and you cannot dollar cost average into a house. So you lock in the price that you pay. And I think we tend to underestimate how much we're going to spend as homeowners, how much it's going to cost to maintain a property. And we overestimate how much joy it's going to bring us. So on the latter point, there was a 2022 academic paper from the Journal of Happiness Studies. I can't believe that's a thing, but it is, that examined measures of subjective well-being in homeowners and in tenants. And they found that homeowners for whom the purchase of the home is like the main reason that they moved, on average, systematically overestimated their long-term satisfaction gain of living in that house. So it gets back to this idea of extrinsically oriented versus intrinsically oriented life goals, and how we tend to have biased beliefs about what's going to make us happy. But on the former point, this one's a little bit easier to assess mathematically. And I believe that assessing it mathematically is crucial, and something that a shockingly small percentage of Americans do before they dig down deep for the down payment, because housing as a narrative is just gospel in the United States. But the median home in the US today is around $450,000 per Fred data. And with mortgage rates hovering around 7%, affordability is pretty much at an all-time low. And we tend to assume that no matter what, no matter how much the house has cost, no matter what the interest rates are, it's always going to be net cheaper than renting. But that's just not the case. It is such a hyper-local equation that sometimes renting and investing the cost difference between your price to buy and your price to rent is going to get you net further ahead than if you had purchased. So my rule of thumb, and the way that I like to think about it, and the way that we will, approach the situation in the future, is I'm going to look at my price to rent ratio in my area as a gauge for whether or not the rental market or the housing market has been hotter in recent years, then compare my unrecoverable costs. So right now we live in a strange market. I can rent a $1 million home for $3,000 a month. But if I were to buy a similar house on my street, and I know because I looked into it and I tried, I would have had a monthly pity of around $6,500, roughly $5,000 of which would have been interest, taxes, and insurance. So in that case, my unrecoverable costs of owning were about $2,000 a month higher than my unrecoverable cost of renting. So obviously in that scenario, you can then flesh that out and say, all right, well, the rental market is obviously going to keep going up. My fixed housing expense will stay the same. How many years would I have to live here for the rental market to eclipse my monthly payment? And in our case, we were going to be long gone by the time that would have happened. So It's not to say that real estate is no longer a good investment. I think that's a laughable statement. However, I do think young people are sold a bill of goods about what buying a house means that often falls short of expectations. And so I'm always just very encouraging of running the numbers, of really understanding what you're getting yourself into, and making sure that you are not lowballing the estimates for how much it's going to cost. Because when the HVAC goes out or when the washer dryer units go kaput, like all of that is going to be on you. And I think a lot of new homeowners, it's a jarring shift that you just want to make sure you are totally ready for and you have the cash available to handle those things when they come your way.
And so it sounds like for you personally, you haven't foreclosed the possibility of home ownership in the future, but your message is, be rigorous, exacting in the way you run the numbers and evaluate whether it's a sensible investment or not, right?
Absolutely. And I think for me, we will probably wait to buy until we know we're settling in one area for at least 10 years and having kids. I think even if buying ended up being net more expensive, I still would probably be okay with it if we were going to have children. Um, because I think in that case, it's a lifestyle that you're purchasing and uh, you're trading flexibility for stability. And in that case, I think it makes a ton of sense. But I think for the two of us and how much we move around and the fact that we don't have any kids, renting fits our lifestyle as well. And it just so happens that we've only ever lived in areas where the house prices far exceed what the rental market has done in the last few years.
I think you've said that you think your generation is especially anxious about money,
Mhm.
that life is especially precarious from an economic
Yeah.
standpoint. Why do you think that's so?
Yeah, I do think so. So I'm working on a piece right now about kind of the vast differences in financial standing amongst the millennial generation specifically. It is a very, very weird cohort in that the top 1 to 5% of millennials are doing extraordinarily well, better than their parents by a long shot. But the vast majority are doing worse. Like there's really no millennial middle class. And I think we can point to a few reasons for that. I think the obvious discount here is age. That, to be middle class, you have to earn a certain income or have a certain level of wealth. And if you're in your late 20s, you may not be there yet. That's fine. But the majority of millennials are in their like late 30s, right? So I think we can point to a few reasons for that. Number one is student loans, that you have this huge cohort coming out of basically starting their careers with this vast amount of debt, the housing market being at kind of all time unaffordability, and then wage suppression over time. So median wages over time have not kept pace with GDP growth, and housing and education costs have dramatically outpaced it. So it's just a math problem at that point. Like I said, we've never seen an entire generation enter their careers with that type of liability on their balance sheets without the asset. So, especially now that we're exiting the ZERP years, I think for our generation, the saving grace is going to be focusing on increasing income, marketable skills, and keeping the save rate high. Like that to me is the only way out, and accepting that our generation is going to build wealth in a way that may not look like what it did for our parents. Like a home may genuinely be out of reach for you right now. I was doing some data digging for an episode of our show where we realized that, the median home value, even with an interest rate of 12% in 1985, when many of the boomers were the age that like your median millennial is now, it still was going to cost about twice as much to put 20% down today as it did back then, all else held equal. So it stands to reason it's going to take you about twice as long. And I think the saving grace is that, to my earlier comments about financial technology, our parents didn't have apps on the supercomputers in their pockets where they could buy a broad-based ETF for free. Like we have way more access to the stock market, the greatest wealth building machine of all time, than ever before. But in order to really leverage that and take advantage of it, you have to have the discretionary income to do so. And so I think finding ways to market yourself and earn more quickly and to get skin in the game is to me the most viable option.
Well, that's sage advice. Katie, this has been and enjoyable conversation. Thanks so much for sharing your insights with
you.
us.
Thanks, Jeff. Yeah, it was a pleasure.
Thanks for joining us on The Long View. If you could, please take a minute to subscribe to and rate the podcast on Apple, Spotify, or wherever you get your podcasts. You can follow us on Twitter at SYouth1, which is SYOUTH and the number 1.
And at Christine_Benz.
George Cassidy is our engineer for the podcast, and Carrie Gretchick produces the show notes each week. Finally, we'd love to get your feedback. If you have a comment or a guest idea, please email us at thelongview@morningstar.com. Until next time, thanks for joining us.
This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. While this guest may license or offer products and services of Morningstar and its affiliates, unless otherwise stated, he or she is not affiliated with Morningstar and its affiliates. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. Jeff Patak is an employee of Morningstar Research Services, LLC. Morningstar Research Services is a subsidiary of Morningstar Inc. and is registered with the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analyses, or opinions, or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.